following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome to this inaugural episode of Volatility Views. We've had a few sneak preview episodes in the can now, including that fantastic show last week from Boca with my co-host here, Don Schlesinger. Don, how are you doing this lovely Friday afternoon?
Just great, Mark. Good to be back, although I miss those 80-degree temperatures.
I was just saying the same thing. We really need to make that a regular occurrence. Let's just fly down there every week and just do the show from croquet courtside at the Boca Resort and Club. What do you say?
Well, it beats the snow that greeted me the next day that I got back, that's for sure.
You had snow when you got back? Oh, that's awful.
We did.
I think the budget of the show could accommodate a weekly trip to Florida for both of us. What do you say?
I'm in.
I like it. That was just a good way, a nice relaxing place to do a volatility show. And listeners, we are joined this week in our premiere episode by our inaugural guest. He is Dan Passarelli, the founder and head honcho over at Market Taker Mentoring. Dan, welcome to the program.
Hey, thanks, Mark. I'm really glad to be here.
Is that your official title, head honcho? You like that?
Yeah, it is. I've got that on my desk here, a little marble, plaque. Dan Passarelli, head honcho, Market Taker Mentoring.
I can also refer to you as Viceroy if you prefer.
Yes, and also janitor.
Yeah, you gotta love having a small shop. You wear many hats, including janitorial on occasion. Well, Dan, since this is your first appearance on Volatility Views, and I believe your first appearance on the Options Insider Radio Network in general, let's start off with what we do with all of our first-timers. Give our listeners a bit of an overview of your background in the derivatives business.
Sure, Mark. Yeah, like you, I traded down on the floor of the CBOE for a long time. I got started in this business in 1993, right out of college, wet behind the ears, a youngster, a young lad, and worked my way up to being a market maker. And I traded mostly equity options on the CBOE, but dabbled a little bit in other stuff. Traded a little bit of the indexes, and also traded at the Board of Trade in the agricultural products, traded corn options for a bit. Since I left the floor in 2005, although I guess I did return to it briefly afterwards, been teaching. Wrote my book, Trading Option Greeks. Got another one coming out in the very near future. And my firm here, Market Taker Mentoring, LLC, has the objective of teaching the world options one trader at a time.
That's true. I neglected to include author in your list of many titles. So you have the Trading Options Greeks. Is that the only book? Or I think you had two books.
Yeah, well, I've got the other one, which is in edits right now, and it should be out at the end of the summer.
Oh, so that one isn't even out yet. So I'm predating you then.
Yeah, exactly. But I'll tell you.
Insider information. I didn't mean to leak that. We'll edit all that out. Well, Dan, it's great to have you on the program. I know you and I have talked back and forth about bringing you on a number of times, so I'm glad we can make it work. And good timing for this inaugural episode here of Volatility Views. And with that, we will dive right into the Volatility Week in Review. and welcome to the Volatility Week In Review. As the name suggests, this is where we sit back and discuss what we've been seeing in terms of volatility and volatility trading this past week. And it has been a continuation of the trend that Don and I discussed on the previous show of vol really starting to take a steep downturn after spiking. But we saw a sharp spike in the VIX cash back on March 16th. And since then, the SPX vol and VIX have just been on a steady downward trend as concerns have gradually lessened over Libya and Japan and a few other areas, as well as a steady state of decent earnings coming out of the market and some decent economic numbers. It seems to have lessened the overall level of concern we're seeing in the markets. Of course, right now you can argue that the sell-off is maybe being a little bit overdone. We're seeing the VIX cash right now as we're recording hovering at 1767, down about 2%. So it is coming back a little bit today. It was down significantly more than that earlier this session. You know, we can also have a lengthy discussion, I think, too, about just the viability of VIX cash as any sort of predictive or volatility gauge. I think a lot of retail, when they first come to volatility and they first learn about volatility trading, their first stop obviously is the VIX, and they look at the VIX cash. And I lost track of how many times we've received inquiries over at our website. I'm sure, Dan, you get a lot of these as well at the mentoring firm. Why are the VIX options not queuing off of the VIX cash? You know, we probably get that about 10 times a day, I would say.
Oh, goodness, if I had a nickel.
Yeah, exactly. And so there's a lot of over-reliance placed on that cash number. I mean, if you look at the futures rolling out to April, you got 19.5 on the April VIX future, May VIX future, nearly 21, and the June 21.5. So obviously there is a volatility premium being priced into this market right now, but that's not really being reflected in what we're seeing in the VIX cash numbers, which is a front month index, and you're also seeing the effect of the weekend being taken out as well as the skew just being absolutely crushed. Speaking of skew, have Dan or Don, have either of you guys paid attention to this new index they just released, the actual Skew Index that the CBOE started tracking recently?
I took a look at it when they first described what it was intended to do, and I have to say I was a little bit skeptical about what they dubbed the Black Swan effect. It's certainly a valid exercise to measure skew, which again is just the difference in implied volatility as you go over a range of strike prices beginning way below the market and continuing through the current spot and then to the above the market options. And it's certainly valid to track the steepness of that skew, but I just thought it was a somewhat far-fetched to dub this the Black Swan effect, because those who are familiar with Nassim Taleb's work and his whole premise, the entire idea of a Black Swan event is something that's unpredictable. It's a major event which cannot be foreseen. So to say that the skew is in some way predicting or foreshadowing such an event flies in the very face of the definition of what such an event is in the first place, which is that it's unforeseeable and unpredictable. So other than that objection, I have nothing against measuring skew, but I'm not 100% sure just how useful that particular measure is.
I think we can probably ask that for a lot of the new products we're seeing coming out that are targeted at volatility and volatility traders. And of course, I agree with you that the unpredictable nature of the Black Swan events makes them very difficult to predict by definition. Yet that never stood in the way of good marketing, you know. And it sounds good to say that this is essentially the Black Swan indicator. So that works well. If you're trying to recapture that sexiness of the fear gauge, then Black Swan is probably the next best way to go. What about you, Dan? Have you been watching this at all?
Yeah, I have. And just to kind of chime in with what Don was saying, you know, skew is incredibly important to watch. I mean, anybody, especially if you're a reasonably large trader, you need to watch skew. But as far as calling it a Black Swan indicator, you know, Black Swan events are events that are like, you know, 3, 4, 5, 10 standard deviation likelihood things. They're incredibly unlikely events. To watch the skew indicator go from 110 to 120, that doesn't have anything to do with black swan events. But to that point, though, I think it is a useful product just to kind of give you an idea of what's going on. I mean, for a long time, people watch the put-call ratio. And I've been kind of a long-time proponent saying I don't think that that's really incredibly useful at all. But this, on the other hand, this is a little different. This doesn't just tell you how many calls or puts traded because you don't know if people are buying or selling them. The proof is kind of in the pudding, where if the skew rises, we know that people are going into the market and buying up puts. Now, we don't know why they are, but still, we've got one more piece of the puzzle that we can use, and it's more useful information than we've seen out there.
Yeah, there is utility to it. When we discuss skew quite a bit, and I'm sure you go over it quite a bit with all of your various students as well, because obviously to be a successful options trader, you need to understand that phenomenon. And, the way they've captured it in this index here is a little bit obtuse. They have these bizarre numbers from 100 to 150, but essentially the way they've broken it down is 100 is the zero downside premium, essentially zero tail risk number, and 150 is imminent, I guess according to them, imminent black swan. And then, so somewhere in the middle of that range is somewhat normal. I guess the average is around 115 historically for how they calculate this index. And right now, if you're looking at the numbers, it's gone from about 126, a peak last week after that high in the VIX cash, down to about 119.97 yesterday. So obviously the tail risk, the premium in these downside puts is coming in the SPX, which is an unusual phenomenon. We've been watching that in some of our other shows for months now. And no matter what's happened in the underlying of the VIX cash or just in the markets and volatility in general, there's been that inherent premium in these downside puts. And that apparently is starting to come off, which I think is interesting. So Dan, are you starting to counsel some of your students that this is a good time to pick up that downside protection, particularly if they're worried, like a lot of people are these days, about these current valuation levels or maybe what's going on in Japan or Portugal?
Yeah, Mark, the last couple of weeks, I've written probably 4 or 5 articles about the fact that implied volatility was too high and it was a great time to be selling options, in particular selling put spreads, which I had in my newsletter last week. And now, now it's just the opposite. I kind of have to go back to my constituary here and tell them, hey, you know what I said last week? Now the world's different. The thing is that traders tend to have very short attention. Oh, look, a squirrel. Wait, what were we talking about? Oh, yeah. Traders have short attention spans. And that's the thing, is that last week the sky was falling, the world was ending. Well, 2 weeks ago, I guess. And now it's like everything's coming up roses. We're down at the low end of the range for the VIX for the last year. And is the world really that much fundamentally different than it was a week and a half ago?
Yeah, we discussed that quite a bit. Don and I had this conversation last week in that idyllic setting about, it looked like there was significant literal weekend risk last weekend that looked like the world might end and Chernobyl 2 might be in the offing there in Japan. And now you're right, little over a week later, those fears seem to have subsided, even though the conditions in Japan don't seem to have improved markedly. And yet, apparently the fear of a meltdown there has been built in now, and the fears of Libya are easing. And apparently the world is a markedly better place right now than it was a week and a half ago. I guess all it takes is a few M&A deals and some decent rounds of earnings and a couple of good economic numbers, and all of a sudden, all those other concerns are put by the wayside.
And also, Mark, don't lose sight of the fact, because there's a tremendous correlation here, to up markets practically every day of the week or even beyond into last week. And this is simply what happens. Everybody looks at VIX as a fear gauge and the skew and the implied volatilities. I'd argue a great deal, and perhaps it'll be the subject of a future show, that VIX is very much reactive with implied volatilities as it is predictive in nature. And so if you tell me the skew has flattened and implied volatilities have come in, and I was on the moon and dropped in here, I would come and say, I'll bet you the market's been up sharply for the last week or so. It's simply the way it works. You have this very strong negative correlation between equity price and options implied volatility, and actually realized volatility to some extent, because it happens to be true that when markets drop, they do so often in a more precipitous fashion than when they rise, sometimes more of an orderly fashion. And so you really do get an asymmetry, even with realized volatility, between downside volatility and upside volatility. And it's undoubtedly true that you're seeing some of the result of this upward market movement now making its way into the skew and into overall implied volatilities in general, as VIX has fallen from 31 to 17.
Yeah, that's true. We are just traveling along the skew curve in a purely theoretical sense. So as the market rallies, this vol is going to come off. You can argue whether it's been overdone or underdone, or whether they're hitting certain parts of the skew more aggressively than they should be. And speaking of curves and volatility, obviously there are other volatility products floating around as well. Don, what's been going on? I know last week, and Dan, I'm not sure if you had a chance to hear our show last week, but we had an interesting conversation about what's been going on in some of the currency volatilities as well, and how particularly around some of the new products that Volex has launched with the CME, with their new vol contracts on the euro particularly, and how they started off with an amazing level of volatility premium that has come off precipitously over the past few weeks, and it was a result of seeing the old ways, I suppose you could say, the old ways of pricing implied vol versus the new way of pricing actual realized vol. So, Don, have we seen a continuation of that? Have we seen Eurovol continue to come off and continue to adjust, or has that process essentially completed itself now?
It's interesting, and we had the expiration of the March contract at a very low 7.88. We mentioned last week that was a considerable drop from the opening day settlement price. Now we have two contracts. We have the front month being April realized volatility, and that's a 1 month product. And then we have the 3 month that we call a 3-vol, 3 months worth of realized volatility for April, May, and June. And of course, that would be expiring commensurate with the June options and with the June CME expiration date for the currency product. And right now, we see levels for the April contract at just slightly over 10, so considerably higher than the 7.88. And the 3 month June is right around 12. I think it settled at 11.99 last night. So you have at least a forecast of higher volatility, and to that extent, we're 14 days into what we call the realized volatility period for April, which is to say the calculation period where we feed the closing prices into the formula. And I'm looking on our website now, and I see that partial volatility realized over the last 14 days of the 25-day settlement period is actually 9.31. So things seem to be on the rise a little bit here.
It sounds like the shakedown process is complete, and they've zeroed in on their levels, and they've actually started to price the actual realized vol as opposed to still building in the old implied way of doing business.
Yes, and of course, once you get into the realized volatility period where the calculation is underway, as opposed to trading the contract before that period begins, where there's more sentiment and more anticipation, as I mentioned last week, you have to respect the calculation. You have to start paying the piper and paying attention to the ever-increasing number of data points that are going to eventually determine the settlement price.
Indeed. And I think with that rundown, we will close out the Volatility Week in Review and move on into our strategy session.
The strategy session.
And welcome to the strategy session. This is the part of the show where Don and I, and sometimes a guest, sit down and discuss one particular strategy or trading technique in detail and discuss its pros and cons. And And last week, we kind of hit on an interesting topic that we wanted to explore in more detail this week, and that was, of course, delta neutral trading. And if you've been around options for any period of time, then this is a term that should be somewhat familiar to you. It's pretty much the way most, if not all, professional options traders, at least in the market maker and liquidity providing sense, trade this way. And Dan, since you're the guest, I'll toss it to you. I'll give you the fun of defining what delta neutral is for our audience.
Sure, Mark. Delta neutral trading, as the name implies, is when you trade with, well, a delta that is reasonably close to zero. So now let's kind of back up for a second. Delta, for those of you who may have missed last week's show, delta is just simply a measure of the directional sensitivity of the value of an option or option position. If an option or option position has a positive delta, it makes money as the underlying rises and loses money as the underlying falls. If an option or option position has a negative delta, it loses money as the underlying rises and makes money as the underlying falls. Now, options have a lot of other different types of characteristics that influence their prices. As you understand, we've been talking about volatility through this whole discussion, the VIX and implied volatility. Well, that's one of them. So is time decay, so is interest, and perhaps dividends. So a lot of people, especially well-capitalized, savvy, professional traders, they prefer to trade the other option-centric risks and get rid of the whole directional risk thing. Get rid of delta altogether. And the way they do that, the way professionals do that is they take their position, they look at the delta of the position, and they buy or sell short shares of the underlying asset to make that delta zero. So then all they're left with is really the option-centric or volatility risks to trade.
Now, Dan, this is why we wanted to have you on the show this week. I think it seemed like a good fit. After all, you are the man who literally wrote the book on the Greeks. So this seemed like a segment that would be right up your alley. And now, as you, I'm sure, did when you were on the floor, Dan, and I did as well, you were trained to trade delta neutral. That's just how we did it. We were volatility traders, quote unquote. We weren't trading direction. You were in there to look at volatility levels, and that's pretty much how we traded. And now, obviously, Don, when we talked about this last week, we touched on it a little bit, but this is a good time to get in more depth about this, because the concept of using delta neutral, it's been, I suppose you can say, misconstrued over the years, as by doing this, by eliminating your directional risk and focusing exclusively on Vega, that you were somehow capturing the pure volatility of the underlying. And this was the best way to do that and the most efficient way to go after the pure volatility of the underlying.
Well, I guess as I said last week, it's a noble goal. So what you set out to do and what you actually wind up doing are sometimes two very different concepts. The idea is that by delta neutral hedging, especially a straddle or a strangle, a position that would be kept, as Dan described, delta neutral either intraday or at the end of the day, is the classic or traditional way of trying to actually capture the volatility of the underlying asset. And in theory, it's something that works a good deal of the time, but it isn't as pure a manner of capturing it as would be, for example, a vol swap or our new volatility contracts. And that's simply because in doing the delta neutral hedging, you also are very susceptible to the path that the underlying takes. So we call it a path-dependent outcome. And what that means, without getting too technical, is your options have strike price.
By all means, get technical. We like to get technical here.
Well, your options
the
have
wonkier, the better.
And since the option has a strike price, you often start out right where the spot is or very close to the forward value. Let's call it 100. As long as you hover around 100, a few percent in either direction, you do your delta neutral hedging each night. Of course, there are transactions costs. There's a bid offer spread. But if you don't do too many follow-ups to get it to be too cost intensive, you basically are doing a good job of capturing that movement of the underlying. But as you start to stray from the strike price, let's use a dramatic example and say the stock goes to 150 or 170 or something like that, it's obvious that you can't just leave the options alone because referring to the delta that Dan just mentioned, at that particular point, you'd probably have one option, depending on the direction, call or put, with 100 delta or close to it, the other one with 0, and you'd lose the optionality. You'd lose the curvature, the gamma of the position. You can't capture volatility with a straight line product such as a futures contract. And if you're left with a straddle where one option is 100 delta and the other is 0, you don't really have an options position anymore, and you're not capturing anything from day to day. So when that happens, you have to adjust. You've got to roll to the strike that's going to give you that curvature back, and there's a cost involved with doing that, as there would be if there were a gap movement and you didn't have the opportunity to capture volatility gradually, but this move hit you all at once, kind of take you unawares. Finally, a second component of this path dependency is you can have a certain volatility that you're trying to capture over the time period, let's say a month, and at the end of the month you look back and you say, well, that was 25 volatility. But it actually matters how the 25 volatility manifested itself, because you might have had a very volatile period at the beginning and then it tapered off at the end. Or you may have had just the opposite with a slow beginning and a great deal of volatility at the end, and that dramatically changes just how your hedging takes place, because the gamma, the rate at which the delta changes, actually changes itself over time. So it becomes, for at-the-money options, very, very sensitive towards the end, very, very big, where even a small movement can produce a very great change in the deltas, causing your hedge, obviously, to have to come along with that. So the entire process is somewhat subjective to the path that the underlying takes during the period in which you're trying to capture volatility.
And that's true. The delta neutral process is, for all of its benefits, it is a very inefficient process. Even if the path stays relatively straight and narrow and you can maintain your initial position, you still have a lot of hedging to do, whether it's hedging your gamma, adjusting your gamma, because your delta will change, you're right, as the underlying moves. And also, if the underlying moves dramatically, you will, as you said, have to adjust your position, because your options will essentially have you're right, you'll have 100 delta and a 0 delta, essentially, especially going towards expiration. So there's a tremendous amount of inefficiencies that have gone along with that process. It's also, as a result, it's extremely labor and resource intensive. It generates a lot of commissions. All those delta and gamma hedging generates a lot of commissions. Adjusting the position generates a lot of commissions, and it's a lot of time. So in both those senses, that's probably why it's remained the relative domain of most of the institutional type traders. I'm curious, Dan, I imagine the bulk of your students coming in are on the high end of the retail spectrum. Do you train them in delta neutral trading? Is this the way you teach them to use volatility, or do you do some other approach in your mentoring?
Well, I do both. It depends on the student. Much of my program is tailored to the specific needs of the student. With my very, very, clever and experienced traders, I have talked about gamma scalping, delta neutral trading. But that requires retail portfolio margining in order to do that for a retail, or what I call stay-at-home trader. So I have trained maybe about 30% of my students to trade delta neutral. However, that being said, every single one of my students gets trained heavily in volatility for two reasons. One, because every single option has a volatility component to its pricing that's somewhat based off expectations for future volatility, so you need to understand realized volatility. And of course, the proof is in the pudding when it comes to implied volatility. That's basically how cheap or expensive your options are. So even brand new traders, I get them deeply ingrained in the concepts of volatility so that they can gain an edge in their trading. And if they're buying options, they make sure that volatility is cheap. And if they're selling options, they make sure that volatility is expensive.
Yeah, that kind of harkens back to what we hear quite a bit these days is the perception, or the difference in perception, I suppose you could say, between retail and institutional when it comes to their options trading. This is starting to change, particularly as the higher end of the retail spectrum has access to education like yours, Dan, and other areas where they could improve their trading. But the traditional demarcation between the two, and when people ask me traditionally, what is your historical difference or definition of the difference between institutional and retail trading, I would say retail is predominantly more directional focused. They focus more on delta. They're looking to make their directional gains, whereas institutional, they do implement things like delta neutral, and they do tend to focus more on the vol level and the skew. So they will think of where they got into a position and what vol level that was and what vol level they're doing a spread on, versus a retail person will typically look at the price that they picked up their option at and what their delta movement will be with the underlying, and looking to capture their profits that way. So, Dan, would you agree with that, or would you say that is starting to go away?
I would agree with that, certainly. However, I think there is one sort of thing that we're overlooking a little bit, although I think you did allude to it just a bit, is that there's sort of a retail trader-based quasi-delta neutral trading that has really been gaining popularity over probably the past 5 to 7 years, and that's income trading. Things like selling iron condors and trading butterflies, where you sell the guts and buy the wings.
That's true. Condors and all these credit spreads have just exploded in popularity the past few years.
Yeah, and, that is a series of strategies where when the trader initiates them, their delta is close to zero, and they do bear the risk of gamma changing their delta, sort of like we've been talking about, but from the short side of gamma.
Yes, that's true. And now, just to put an exclamation point or a period on this conversation, we wanted to talk a little bit about delta neutral, what it is and why people use it. And, Don obviously has one viewpoint that it is very inefficient. I tend to fall somewhere in the middle. But, there aren't many real alternatives at this point. If you're not going to do delta neutral, Don, do you think people should go into the realized vol or the variance swaps? That's your preferred method?
Well, of course, my ultimate preferred method would be to come to the volatility exchange, where the world will come to trade realized volatility contracts, and we've got one down and many dozens to come. But
in lieu of that, until we have all the listings in place.
While we're waiting for that to become a reality, I would imagine that it remains the domain of volatility and variance swaps to capture pure realized volatility. It's a formula. It's the same formula that we use for vol contracts, a classic or traditional standard deviation formula. And you simply contract with a beginning reference level, a strike price, if you will, and you make money if the volatility that's realized is greater than that number, and if you buy it, and you lose money if it's less. So there aren't follow-up daily transactions costs. You're not subject to this loss of optionality that we discussed if there's a big movement, and what you see is what you get, and what you get is the pure formula-driven realized volatility of the underlying asset. So we can do that now with one asset, the Euro FX with vol contracts, and again, hopefully coming soon, we'll be able to do it with a lot of other underlyings as well.
It's interesting. The goal for a lot of these products has always been to break into that glorious OTC cabal of the variance swaps and the volatility swaps that are going on a regular basis to a tremendous amount of size in the OTC market. And we've seen limited success with that. CBOE launched their variance swaps a few years ago and haven't really gained much traction with that market. But, as this discussion has progressed, it makes me wonder if there may be a new tack to take with these products, not just with the variance swaps and, the CBOE's products, but also any future realized vol products aimed at this area that Volex may have. There is a growing level of sophistication in that retail audience. Some of the clients who are very invested in their options education, like some of Dan's and some of the other mentoring clients out there, who are really on the sophisticated end of the spectrum, this might be a new market for this, where as opposed to trying to go after, like I said, that institutional variance swap customer, you can go to the retail and say, here are the numerous inefficiencies of delta neutral hedging and delta neutral trading. Here are the reasons why this probably would not be the best solution for you. And instead, here is a realized vol or a swap product that will do this for you with a much higher degree of efficiency. And that's something I think a few years ago I never would have said that the retail would be ready for a product like this. But we're seeing quite a bit of shifting from institutional to retail these days. And I think that might be the new growth market for this product going down the road.
No question about it. And, again, I tip my hat to VIX marketing, because they certainly have captured a very large slice of the retail audience. VIX is not just an institutional product, but once again, in terms of the kind of job that it does in capturing the actual volatility of the underlying asset, that's another story. So I think the future may very well lie in retail participation along with institutional, but hopefully, at least from our point of view, taking a look at realized volatility products as well.
Well, like I told you when we first started doing this show, one of the first questions we receive, and one of the most common questions we receive from people is, how do I trade the VIX? Why is it not queuing off of the VIX cash? The second question we usually receive from them after they become a little more nuanced, a month or two down the road, they come back to us and say, why isn't this real, pure volatility? Why is this an implied volatility? And once they come around to that realization, I think they are looking for other products. So I'd imagine that products that fall into that realized realm will hit the mark quite a bit.
Quote you in our marketing material, Mark.
Yeah, there we go. But like I said, that's a common question we actually have received, and one of the reasons why I wanted to do this show is to show that volatility is not just one product or one concept, and it's not just one theory. I think you can almost call it a religious divide these days of implied versus real volatility, and which is the most useful. I've lost track of how many panels and conferences I've gone to and been on where the debate is over whether volatility is an asset class now and whether VIX is a good indicator and whether implied is the right way to go. And so I thought the time was definitely right to have a show devoted to that religious divide. And with that, I think we're going to close out this strategy session and roll right into the crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is the section of the show where Don and I and Dan will sit here and prognosticate wildly about the future of the markets. Now, actually, we will talk about what we expect and what some of the expected movements, some of the expected activity we plan to see in the coming week for volatility. And Dan and I discussed earlier that we do believe that some of the downside crushing, you could say, in the SPX skew has been a wee bit overdone. And so it is a good time going forward right now to pick up the downside protection if you're looking at protecting your overall portfolio or if you're concerned about some of these valuation levels. Because I'm sure you concur, Dan, these levels, these buying opportunities in downside premium, especially in the S, they don't come around too often. You want to grab them when they're here.
Exactly. The last couple of weeks, like I said, I've been talking about traders needing to go in there and sell some options because volatility's been too high, and now I'm kind of advocating the opposite. And I think a lot of that plays into the idea that I would say volatility is probably easier to trade than stocks. Granted, it's more complex, but I think it's a lot more predictable. Like, if a stock, or a future for that matter, is up on its high, well, realistically, a professor would tell you that there's probably about a 50-50 shot of it going higher or 50-50 shot of it going lower. When the VIX or some other implied volatility is up on its high for the year, there's a pretty good chance it's going to go back down and revert to its mean. And so trading volatility is more like trading a sine wave, if you will. When it gets cheap, you can buy it because odds are in your favor it's going to go up. When it gets expensive, you can sell it because odds are in your favor it's going to go down.
So you think Joe Retail then can wrap their heads around the vagaries of volatility easier than they can a stock?
Well, let me qualify my past statement. I think that for traders who are educated and really understand the nuances of implied and realized volatility, and it goes beyond just really fully appreciating the definitions. There's little quirks and things that you really need to know, and I've got a whole 5-hour series on volatility, and I could still talk for another 5 hours on it. Once you get that down, I think it's easier rather. Believe me, nothing in trading is easy, but I think it's easier than trading direction.
I think once you get your head around that, there is some truth to that. And, looking forward, I know, Don, you mentioned that the currencies are looking to the upside for risk premium. So I suppose by gauging by that, we should expect to see a surge of vol in the coming week in euro and some of the other currencies that you track.
Well, here's something that's interesting. If you go to our website, which is volex.us, and you navigate a little through the menu down at data and then the Volex indices and a table, we have a comprehensive list of many of the world's most important assets. And off to the right, we have forecasts. I didn't have a chance to speak about this, but Professor Robert Engel, who is a Nobel Prize winner for his pioneering work on the Arch and Garch models, actually now has a Volatility Institute that's housed at the NYU Stern School of Business here in New York. And we have partnered with them, and they are providing forecasts for us over the 1 month, 3 month, and 1 year periods of all of the major underlying assets for which we have historical indices looking backward. So if you go to this table that I was referring to, you can actually see the Volatility Institute's forecasts for the coming 1 month, 3 month, and 1 year time periods in all of the major assets. I'm looking at the euro right now, and for example, over the 1 month period, they're forecasting 9.66, fairly close to the 10 that the contract closed at last night. So this is an interesting tool that we hope traders and those who are considering trading volatility will avail themselves of. Just go to the website and take a look at the data.
Interesting. They're actually predicting a mild sell-off then in euro vol over the coming month.
Well, as always, remember that there's an implied factor in all of these pricings. There's the risk premium that people pay for volatility and that the sellers demand or command because of taking the open-ended risk. So what you pay for an option or what you might pay as long as there's still some time left in a volatility contract, and what the ultimate realized volatility is when the calculation is over are forever two different things.
I just found that surprising, given all the fluctuations we've seen in some of the leading currencies, the yen, the dollar, and the euro over the past few weeks. I would have expected an increasing forecast as opposed to a stay the same or mild sell-off going forward. So that's an interesting fact that I'm sure a lot of our listeners, especially a lot of our listeners who are getting into the currencies and getting into the FX vol and FX options, I know that's been a growing area for us on our website, would be surprised to hear that.
And again, as my grandfather used to say, the proof of the pudding is in the eating. All it is a forecast by an extremely competent individual and institute, but, everybody's crystal ball is a little bit different, so let's see what happens.
Hence the name of this segment, Don. We each have our own individual crystal balls, and some are more accurate than others, some are a little wilder than others, and Dan's is particularly crazy, but we won't get into that. Well, That's going to do it for this premiere episode of Volatility Views. I want to thank our first guest, Dan, for coming on today. I think that was a fantastic discussion. I know I could probably go on for another hour or so. It's difficult to squeeze it all into a half an hour or 40-odd minutes, and so. But we definitely appreciate you coming on, Dan. And where can our listeners find you if they're interested in learning more about you and reading your book or taking some of your mentoring classes?
Certainly. Please visit us at markettaker.com. That's market as in, well, stock market, and taker, like maker, but taker with a T. So it's two T's in a row. So markettaker.com, come and visit us. And if you have any questions, you can find my email on the website, and I'd be happy to interact with you.
By naming it Market Taker, you have definitely self-selected for the higher end of the spectrum right there, because I imagine it's a very nuanced client who's coming in who understands what the market taking even refers to. That's kind of an inside baseball term.
Yeah, true it is. I prefer to have students who know a little bit coming in the door for sure. That's really my sweet spot in the marketplace.
Well, that is definitely a growing audience. I mean, we've always hit that audience on our network and on our website, and we even put out a lot of content from the Options Industry Conference every year, which hits that same audience, talking about maker-taker models versus traditional models, things that you consider to be the sole exclusive domain of the market makers and institutional traders and the exchange executives. And yet that material always shoots to the top of the business and investing charts in iTunes, which I would consider to be a predominantly retail audience. So there is a growing audience out there, even in that retail spectrum, for things like that and for that kind of information. So I'd imagine more and more are going to come to you understanding what that little inside baseball reference actually refers to.
Yep. Thanks, Mark, and thanks, Don, for having me on the show today.
Yeah, Dan, we'll definitely have to bring you on again down the road. And, of course, my good old co-host, Don, it wasn't quite as scenic this week. But we didn't have the birds chirping in the background or the croquet mallets sounding off in the background, but it's still always fun to get together with you, Don.
Thank you. Likewise. At least as I look out my window, there's no snow, so we're making progress.
Yes, definitely. And with that, we're going to close out this episode of Volatility Views. I want to thank all of our listeners for downloading and subscribing to the sneak preview segments, and continue to look forward to more of these episodes every Monday. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.